Okay, we are live. Right, let's begin. Welcome, guys, to another weekly market analysis by Alphachain. My name is Gavin Pannu, and it's the 4th of July. So for our US-based clients, traders, and just audience, happy 4th of July, happy Independence Day. Okay, right, so let me just give you a quick overview of where we are at this current moment, and then we'll have a look at some of the charts, the economic calendar, and what you need to be prepared for the week ahead. So last week, the focus was entirely with the European Central Bank Forum, which took place on central banking of 2022 from, I think it was Sintra in Portugal. And it saw the world's major central bankers reaffirm their commitment to fighting inflation. I thought it was quite a pivotal meet and forum that had taken place, because there are a couple of sort of key points that we could take away from that. I'm just being mindful of sort of the rhetoric that was used at the time, but there was a particular panel discussion that had three key central bankers. It had ECB's Christine Lagarde, Bank of England's Andrew Bailey, and we also had Jay Powell from the Fed. And one of the sort of key highlights from that meeting was, I'm just looking for the commentary at this current moment. Absolutely, there we go. So what I took away from that panel discussion was that all three central bankers, all three governors of these major central banks concluded that the low inflation regime that has been in place for many years now, right, is a thing of the past. So let me repeat that again, right? A low inflation regime is a thing of the past. That was stated by those members, those governors, right? These central bankers. What does that mean? Well, clearly, that 2% inflation target that's been set by central bankers for many years previously is no longer going to be valid going forward, right? So there will be a new range, that would be set of where inflation should be on an ongoing basis. They haven't given us that indication yet of what that is, but in my estimation, it could be somewhere between sort of the 2 to 5% range, right? So almost what the Bank of Japan has been doing is keeping a yield curve control. We will have similar ones potentially for all central bankers, where they would want to maintain inflation somewhere between the 2 and 5% range. Now the question is, with inflation overshooting not just 2%, but 5%, but even 8% levels, right? Let's see if they can even bring allow the inflation to recede by putting in the measures that they have been putting in, which is aggressive tightening and rate hikes that we've seen. Yeah. So that was one of sort of the key takeaways from last week, is that the central bankers have admitted that we're no longer going to see inflation at 2%, well, anytime soon. But going forward, we're certainly going to see a new dynamic taking place of where we are in a constant environment of inflation being around, at these higher levels that we've not seen previously since the 1970s. And how is that going to impact when it comes to cost of living in the UK, which is a bit of a crisis that's taking place? Recessionary fears across, the Eurobloc, in the UK, and even in the US, right? So, and how central bankers react. And what we've really seen is that their aggression in regards to tightening, so the hawkishness that has come through of them raising rates and tightening, it's a global effect, certainly, because all central bankers are doing it at this moment. But are they going to continue with that rhetoric, or at some point soon will they pause and then review incoming data? That is a key question there. But I thought one of the pivotal points from last week's session is the fact that we will not see inflation how we've seen it previously in the last decade. That is unlikely to occur going forward. We have a new dynamic, a new market structure that is taking place now, where we are in an environment where inflation is likely to be way above those previous targets that we've seen in the previous decade. Okay, what else can we sort of discuss from What are the sort of other key areas that I want to sort of cover? Well, the Manufacturing Purchasing Managers Index data was also mixed last week, with some of the European data beating expectations, but the US PMI data, it just beat the forecast. It just beat the forecast, right? And the Institute of Supply Management, ISM PMI data, that missed the forecast. So the core, which is removing food and energy, so the core personal consumption expenditure data, which is the Fed's preferred inflation measure, came in at 4.7% year over year for May, which was way below the expectations, and it's the lowest level since November. Okay, so these PMI data give us a good insight to how these purchasing managers are going about with ongoing business, right? And it's going to give us the knock-on impact on how that's going to impact consumers later down the road, right? So they're the first point of call when it comes to sort of these, services, manufacturing goods that are coming through the system, through the supply chain, right? So it gives us a good insight to how we're not quite meeting the forecast that we've, once quite easy have met them. Okay, now another key point to mention here is there an environment of where inflation pressures are moderating, right? So there is a lot of call by economists stating that we potentially may be going to stagflation, where inflation still are at these elevated levels, but they're beginning to moderate, which has not been confirmed yet, shall we say. But at the same time, we have falling growth, right? That's the biggest concern that the economy has at this moment, especially when central bankers are very hawkish and have stepped up in regards to their tightening measures, and they are unlikely to be concerned how stocks are doing, how equities are, performing. Markets are down. They're not concerned about the markets being down. They're more concerned about inflation and sort of other factors that come in line with inflation. Yeah. So due to this, the last few weeks, we're seeing where there's not been enough information giving us that indication that inflation pressures are beginning to moderate. At the same time, we're seeing these negative numbers come through from data such as I mentioned, the PMI data, but also we're seeing falling growth data. And that's now seeing markets at these lows, at these sort of, should we say, bear market lows, these bear market territory lows, and remaining choppy. We're seeing a lot of choppiness, especially in previous week's session. There was a lot of chop taking place in markets, testing those ranges of those previous pivot highs and lows. And what we're looking to engage going into this new quarter and this new week is, are we building onto something? Are we going to start to see some gains taking place, or are we going to see more of a bear market and bear territory sort of continue as we have seen in the last few weeks, right? So that's sort of the key point to take away. But before we sort of go ahead and look at sort of what to expect for the week ahead. Now, as I mentioned, today's Monday, the 4th of July. It is the Independence Day in the US. It's a national holiday. So markets will be closed, and therefore there will be less liquidity in the markets, less volume taking place in the markets, right? So it might be a quiet session ahead. But we have a lot of information, a lot of data being released this week, right? I'll cover a lot more into that a little bit later on, but I'll start off with one of the key indicators for me would be is if we see the Reserve Bank of Australia raise rates by 50 basis points again. Okay, so we do have an interest rate decision taking place overnight, sort of early hours of Tuesday morning in the UK time, or overnight. In addition to that, the other area that I'm going to be focusing on is, of course, the FOMC meeting minutes, which will give us a good insight to the most recent interest rate decision and all the sort of, discussion points during those sort of 2-day blackout meeting, right? And that will be released Wednesday late afternoon. But in addition to that, we also have a busy week on the data front, right? We've got a lot more a lot more S&P, global S&P services and composite PMI data to be released. And that's over the next few days. So going to Tuesday, mostly for sort of the European markets. So we've got Wednesday as well. We'll go into the economic calendar as well. But most anticipated this week is, of course, the non-farm payrolls. So the first Friday of each month, we tend to see non-farm payrolls being released. Okay, so we'll do sort of an insight to that also. But let me just mention, it is important when you're trading non-farm payrolls is you've got to gather all the key information around, right? So don't just go on, okay, here's the forecast. If we meet forecast, it's going to be bullish. If we don't meet forecast, it's going to be bearish, right? It's just not, it's not as easy as that. So you've got to have a much more detailed understanding of what the market sentiment is already in regards to the non-farm payrolls. Right, so what I'll do is switch over here and we'll have a look at some of the markets. Before we go into the markets, I'll bring up the economic calendar. So I'm going to have a quick look at where we are at this moment. All right, for the week ahead. So we had CPI data coming in this morning, and this is concerning obviously for the Swiss franc. So the S&B came in at 0.5%, a little bit higher than the forecast. So it came in a little bit higher than the forecast. We've just seen recently the S&B raise rates. And it was a surprise raise, and they raised rates by 50 basis points. So where they were at negative 0.75% interest rate, they're now at 0.25% negative, right? So again, if CPI continues to exceed its forecast, its estimates, then we could see further hawkishness coming in from the S&B. But I do have some other news in regards to the S&B. I'm just trying to see if I've got the chart here as well. What I might do is I might just switch over and look at the Euro Swiss. So the Euro Swiss has hit parity again on further worsening Eurozone economic conditions, and of course, a motivated Swiss National Bank. So just to sort of highlight what we're seeing here, right? So parity means that both currencies, the currency pair that we're reviewing, Euro Swiss, has met the level 1. So it's 1 for 1 when it comes to Euro against the Swiss franc here, right? So we've just gone through the parity level, parity being sort of in this region here, right? Now, let's just highlight that for a start, actually, so that you can clearly see coordinates. We just want, there we are. So it tested it for the first time in quite a few years on the 7th of March. Okay, the 7th of March, 2022, so we tested for the first time this parity level, pulled back quite quickly thereafter, and then that's where we are at this current moment. We're back at that parity level. And just to indicate where, has this happened before? Well, yes, just going back to 2015. I'm not sure how many of you have been trading around that time. I certainly was, and I knew what had happened. And you can quite clearly see it's quite a large candlestick formation there, right? So this was the day that there was a peg. There was a Euro Swiss peg at the 120 mark. So all we saw is, as the S&P put in this peg, where they did not want to see this currency go lower than the 120 mark, we always saw it being traded above the 120. There's a bit of fluctuation around the 120. But it was a bit of a surprise event when the S&P removed the peg. When they removed the peg, we just saw a sharp sell-off taking place in a very short period of time. I'm talking about this is a one-day candle, and a lot of this price action, a lot of this movement occurred less than within that day, right? So within a few hours of that day, right? So we saw a huge sell-off. And in fact, quite a lot of investors and traders around that time, I remember reading into it, had lost their shirt, shall we say, right? So they lost a substantial amount of their net worth and having potentially a long position, and then the S&P removing the peg and they're seeing a huge downside move taking place, right? Where slippage might have occurred and they lost much greater than they expected. So going back from 2015 to where we are now, we're back at those levels. We're back at the parity level. Now the question is, will the S&B intervene, right? Are the S&B likely to intervene? I don't believe so. I don't believe so. With the current macroeconomic environment we're in, right, and we can clearly see inflation overshooting at this moment, it's very unlikely that we're going to see this being impacted, right? Where we're not being impacted, but seeing the S&B step in at any point. So just be mindful that it's very unlikely that S&B is going to step in because of the inflationary concerns that they have. And they had recently already had raised rates, and they may continue to raise rates and get back to sort of, 0% interest rate levels, or maybe in the positive territory. But at this current moment, the S&B are fully aware of where the price is. So the S&B, have stated, as the S&B said that the Swiss franc is no longer highly valued due to recent depreciation, suggesting that there will be less intervention in the Forex market by the S&B, right? So, they're moving away from maintaining certain sort of currency measures. Their focus is clearly on inflation now, right? So this is sort of a key fact that recently taken place, as you can see. But going back over to the economic calendar. So, as we know, the US 4th of July bank holiday is today. Apart from that, we don't have a lot of data, right? We don't have a lot of data. The next one you could be sort of focusing on is tonight, overnight, we have the AIG construction index from the Aussie. But of course, that's not going to be the focus. The focus is going to be what we have at 5:30 a.m. is the cash rate, okay? The cash rate and the RBA rate decision, right? The cash rate and the RBA rate decision. Now, just to sort of indicate what that means is, if I just bring this up here. So the Reserve Bank of Australia cash rate, so the RBA is expected to hike rates by 50 basis points in July. But can it go bigger is the question. Are they going to raise rates further, maybe 75 basis points? Well, what is being priced in is a 50 basis point rate hike. So just be mindful sort of the outcome from this, right? If we see this, and you can clearly see this is where the cash rate has been up until now, and you can see most recently in 2022, we've seen a sharp move to the upside in regards to the interest rate. And this is the forecast. This is what is forecasted. We're likely to see interest rates continue on the same path as we've seen previously. So what is expected is a 50 basis point rate rise. It could be a larger one. That would be the surprise factor in the markets, is if we see the RBA stepping up and going above what the forecast is, right? Now, why is that the case? Key point to mention is, do remember, right at the beginning of this year, we had a large number of COVID cases in Australia, and they'd put in certain restrictions and national lockdowns, or maybe state restricted lockdowns, that really sort of impacted their economic activity and growth expectations. And therefore, they didn't get off the mark to raise rates as some of the other central banks. For example, the first one was the Bank of England, raising rates last year in December for the first time. So they were already behind the mark in regards to raising rates, as they've only done it recently. But now they are maybe wanting to, overstep the mark by becoming even more aggressive than other central bankers, because they are behind the curve, right? So that's what we're sort of expecting, is that we're certainly going to see a 50 basis point rate rise, but could there be a 75 basis point rate rise? That is the key question there. Okay, so moving on, as I mentioned, going into Tuesday, early session, we have a lot of PMI service data, okay, being released from the Euro region. And then we also have in the UK, the Bank of England Financial Stability Report, the FPC meeting minutes, FPC statement, and we have the Bank of England Governor Bailey to speak at 11 a.m. Going into Wednesday's session, just be mindful of time. Wednesday's session, as I mentioned, there's going to be a continuation in regards to some of the PMI data, but coming in from the US, across the pond there. So we're going to have final services PMI and ISM services PMI. But we also have JOLTS, job openings. We have some speeches, right? FOMC and MPC member speeches taking place early, sort of, prior to that. But what will be anticipated is the 7 p.m. FOMC meeting minutes. The minutes is a document, it's a statement document that you're going to be able to review of what was the ongoings in those 2-day blackout meetings that are taking place before the Fed made their decision of raising rates, right? And that's what we're going to sort of find out more information on. Now, what you're looking for is description, right? You're looking for description communication amongst those FOMC members and what their views are. Are they leaning more hawkish? Are they beginning to become dovish, or are they still sort of in a neutral region, right? So just those are sort of the key points to take away from that. Going into Thursday. Now, Thursday, we do have in the UK, we have the Halifax HPI index, so housing price index there to be released. In the Swiss franc sort of related unemployment rate will be released for Switzerland. Looking at some of the Euro bond auctions that are taking place, again, that's tentative, not a specific time. At 12:30, the ECB monetary policy meetings accounts. I think what's going to be anticipated that afternoon on Thursday is the ADP non-farm employment change. Now, this gives us almost an early indication of what to expect for the actual non-farm payrolls. But just note that it's not reflective either, right? Meaning that there is not a high probability that what comes out in ADP is also what's going to come out in non-farm payrolls. There could be some divergence there. Okay, just be mindful of that. And so closing into sort of the Thursday session, there's further speeches that will be taking place. So just be mindful of ongoing rhetoric from central bankers. And then going into the Friday session, as you are aware, the focus will be is non-farm payrolls, okay? And now with non-farm payrolls, not only do we have non-farm employment change, you're also going to have the unemployment rate, you're going to have the average hourly earnings, and you're going to have Canadian data as well, employment change and unemployment rates as well. We have the ECB Lagarde speech taking place prior to that, and a few more speeches thereafter. But most important is, of course, the non-farm payrolls. So coming over to non-farm payrolls, this is what it's looking like at this moment, right? So US non-farm payrolls, has America's hot labor market started to cool off? Okay, so that's what we're seeing. It was already expected to be a lower number, right? So, always time to see, as we've seen with some of these corporations recently who have receded their job offers, are reducing the labor force by, say, up to 10%, right? Is that having now beginning a knock-on impact on the non-farm sort of payrolls, a payroll change here? And of course, the employment rate is going to be released at the same time. It's also forecasted to be sort of at these lower levels, somewhere between 3.5% to 3.8% range. And it's maintained that range for some time now. But the question is, are we going to see that the labor force is beginning to cool off, right? And finally, just to sort of cover all aspects, this Saturday, we will have the CPI data from China. That's something just to keep an eye on. So yeah, just be mindful of the CPI data that's going to be released into the upcoming weekend. One more sort of chart I can sort of also bring into this is Fed rate hike expectations. Now, what we can review is the Fed interest rate probability for May 2023. So we're looking at the Fed fund futures, which points to receding expectations about how high rates will go. Okay, so we can see sort of here it's starting to recede most recently anyway, going in the latter part of June, right? So what they're saying is later on, when we're going into sort of next year, will that continue? Will we continue to see it, hawkishness and rate rises from the Fed? And it's that question, there is that question mark rising now, right? There is certainly a view by market participants here that they can't continue to do this for the long term. It's likely to come to an end earlier than what they have given in their forward guidance and on their dot plot of when they will begin to, take the foot off the accelerator, shall we say. Okay, so that covers the economic calendar. We sort of put that to the side. We now know what to expect for the week ahead, and what are the areas that we should focus on? Let's have a quick wrap on the market so we can have a quick review on where the markets are at this current moment. Yeah, feel free to ask questions as well, guys. This is a time. This is a live session through YouTube, live sessions for our private members in our Zoom communication here. If you have questions, put in your questions in the chat. This is the time to ask your questions, right? Is there a market that you are concerned about? What is it that you're interested in at this current moment, right? But I'll look from a global perspective. Let's start with the S&P 500 and the NASDAQ, these two sort of markets over here. Now, we can quite clearly see that the beginning, I might just do full screen here for the time being, okay? So last week's session, we hit these new lows. We recovered some of those lows. We've seen a pullback in those lows. But then again, as we come into the latter part of the week, we're back in those sort of bear market territories, right? So we're back in this bear market territory. The question is what we're going to see here, right? So the last sort of, candle obviously was a slightly bullish candle there. What do we see in the markets? As I mentioned, it's a national holiday in the US. Don't expect a lot of liquidity, a lot of volatility to occur in the market. We could just see, a small sort of bullish move or small sort of bearish move. But yeah, just be mindful where you see markets likely to go. And a key area of focus for me is this trend line here. So you can see this trend line in this has been in this place for some time, right? So you can see quite a some clean touches since the end of March. Okay, since the 30th of March, those highs. We've been trending lower, so we had a recovery from the, we can say mid-March, say 9th of March lows, or the 24th of Feb to 9th of March, these lows that were put in, these bottoms that were put in. From that point, we had a bit of a bull run, but overall, we are in a bear market territory, right? And since then, we've just continued to make these new lows. So lower lows, lower highs, lower lows being formed. The question is, when we come back to sort of this range again, just shy of around 4,000 mark, so maybe 39.50 or even up to the 39 handle, right? Are we going to see some further selling pressure coming into the markets? And that's what the sort of the key point will be. Is something to mention, which is not occurring this week, is in the US, we've already had the first quarter this year, the GDP come in negative. The question is, when you have two negative GDP quarters, quarterly results, that is a technical recession. That generally means there's a technical recession in play, right? So that will be coming out very soon, the following week, where we'll hear more in regards to the GDP. And that's going to give us a good indication of, if that recessionary phase is going to continue. But at the current moment, we could see markets just fluctuate between sort of the previous lows and the previous highs, as we've seen. We're waiting for the next bear takeover to come into play. And I don't quite see that yet. I would want to see sort of a technical level being reached. So maybe potentially a key level of resistance or potential the trend line support that we have here, or resistance level that we have here. NASDAQ is still sort of, further in the slump than the S&P 500 is. Still sort of breaking down these lows now, so you can see over here. I might just adjust sort of some trend line analysis here. Okay, so and remove that. Yeah, so we continue this bearish move. It's a far more aggressive gradient in regards to the S&P 500 to the downside. The question is, are we going to see a continuation? That's sort of the key view there. But again, you've got to be mindful of the key levels, right? So the 12,000 figure is sort of a key level to be sort of wary of. We saw the false breakthrough, and then it failed to sort of stay above that level and back below those levels. We're now around the 11,500 or just above the 11,500 region, right? We've got the next key level support around the 10,746 level as well. Now, what I might also look at, if we just come over to the dollar index, actually, let's have a quick look at the dollar index. So we spoke about the Euro-Swiss parity, right? But in addition to that, the dollar has been one of the strongest performing currency year to date, right? It's been one of the strongest performing currency year to date. I did actually close a page here, which I should have. Just give me a moment. Let me see if I've got it here. Yeah, so the euro dollar has been one of the outperforming currencies so far. Just to show you that, here we are. So what we're seeing is major currency against the US dollar. So this is year to date, and it's been rebased to 100. Okay, so starting around the 100 mark, right? And what we're seeing is clearly this is the dollar here. the line in red is the dollar index, which has outperformed all other basket of currencies. Okay, so we could clearly see the yen has been the weakest. So there's a huge divergence. And why is that divergence in play? Well, quite clearly, it's about central bankers, right? We've seen the Fed being the most hawkish when it comes to all central bankers out there, right? And then we've seen the Bank of Japan being the most accommodative, right, at this current moment. And it's the first time in the last few weeks we've seen that their yield, their inflation rate has surpassed the 2%, where they've outlined their yield curve control, the YCC limits, right? So it's just crossed above that, and we're seeing now, their interest rate just surpassing the 2% mark now. So the question is, are they going to maintain an accommodative policy? We've just heard from a governor, that's part of the BOJ, who has continued with the rhetoric that we're likely to see an accommodative stance for the foreseeable future, right? So there is no change on their policy, at this current moment. And that's why the yen is the weakest currency, but the Fed has been the most hawkish, raising rates, even 75 basis point rate hikes occurring. And that's why we've seen them at the sort of higher estimates. Now, something else that you might find surprising is that the pound, if we look at the pound, look at where the pound is, it's the second weakest currency. And you might be thinking, hang on, how's that the case, right? We've seen that the Bank of England has raised rates. It's the first central bank to raise rates back in December of 2021, right? And it's continued with 5 consecutive rate rises, right? But the key point there to take away is that market participants are now beginning to see that there is more recessionary fears than there is that optimism that these rate hikes are controlling inflation measures, where inflation in the UK is forecasted in the next few months to potentially be in double digits and hit 11%. Okay, so the big question there is the Bank of England doing enough to tame inflation, right? It clearly doesn't indicate that at this moment, because there's been no moderation in the inflation rate, and we're seeing inflation maybe into double digits in the next upcoming few months. Then you have the cost of living crisis with sort of energy concern and so and so, which is certainly, putting a lot of fear in the UK economy at this moment. And that's why we're seeing the pound being one of the weakest currency, because if there is a recession, there is certainly a recession at this current moment in the UK, and it's likely to be the first country to go into a recession or be confirmed in a recession. And that's what this is reflecting at this current moment, is that even though we've seen 5 small incremental rate rises from the Bank of England, but clearly the market participants are seeing that that is not enough to tame inflation, to recede and moderate sort of inflation levels, right? And that the balancing act that they're trying to place to ensure that there's continuation in growth and that the cost of living doesn't sort of, have a significant negative impact, they've not done enough compared to other central bankers, right? So yeah, the pound is not faring so well, shall we say. And then you have, I believe you have, let's double check. Yeah, so Kiwi, you've got the Kiwi, and then you got the Euro. So the Kiwi Euro is sort of at this same region in weakness. And then you've got, of course, the Aussie and the Canadian dollar, right? So Canadian dollar is holding well, but still, I mean, if you just look at across the board, the dollar's outperforming, all other currencies are underperforming. Okay, we'll close that for timing. So that brings us over to the US dollar. So the US dollar is clearly back above the 105 handle, as you can see, and we're testing this upper region of price action. Now, what I might do is just full screen this, go to the daily view, so you can quickly see what's been sort of the trend as you can see year to date, right? So look at the move that we're seeing so far, right? So looking at where the lows are, where these lows are, I mean, the lowest point achieved in the dollar index, I believe, let me just zoom into this portion of price action here, was on this candle here, and it tested almost a low of 89.20 handle, 89.20 is the low, which was the 6th of January 2021, right? And if you now compare that to when's the all-time high in the S&P 500, I believe it was the 4th of Jan, right? So there is a 2-day lag there, 2-day lag in regards to the top and the bottom of looking at the currency, US dollar index versus the S&P 500. So the low, the bottom for the dollar index was the 6th of Jan of this year. Oh, sorry, I'm taking this all the way back to last year then, sorry. Well, I'm getting ahead of myself there. Okay, so it's the 6th of Jan of 2021. So the 6th of Jan of 2021, where the low was put into place. But since then, we've just seen a strong bull trend. So with the first bull move going up to sort of test the 93.50 handle, then it's receded back down to test the lows, not quite the lows of the prior lows, but we come almost within sort of, the same distance of the same price range. So testing around the 89.50 handle. From that point onwards, we've seen a strong bull run. So the bull run goes into all the way through to the early part of 2022. So we said a bit of consolidation, and we're not quite at the $100 mark into sort of 2022, right? So we go on to sort of reach a high of 96.80 handle, 97 handle, should we say? And then it's in 2022, you had this ultimate sort of bull run taking place, right? Look at the gradient of this move into sort of 2022, where we're back at these highs around the 105 handle now. So just to go back, how far back do we need to go to see sort of these levels being met? You can quite clearly see it's some time ago. So we're looking back at 2003, okay? So 2002, 2003 levels. So yeah. Certainly, we're looking at another breakout taking place. Now, the question is this going to be followed through? That's what we're looking for. You do need to close of the high, okay? You do need to close of the 105.82 handle high, okay? But it's quite bullish at this moment, right? It's quite bullish at this moment. So the question that you need to ask yourself at this stage is, are traders, beginning to see that we're going to top out at this level? Are we going to see a continuation on this move here? It's quite a strong level that we've seen, right? So we've tested this region a few times previously to this, right? So you can see in this region here. So I'll be just very cautious of a breakout. Just be mindful there could be a false breakout before we see a bit more selling pressure coming into place. Maybe a strong breakthrough and a close above the 106 handle might confirm the continuation of the bull run. But just be mindful, sort of, we're at these toppy levels at this current moment. Yeah. Let me just bring in. Okay, so the VIX, at some point it did reach sort of these 30 levels that we've seen previously, but it's back below. So the VIX and the VXN for the Nasdaq, you can see sort of, they are receding. They're back below the 30 mark. The VIX is at 26.71 at this current moment. Yeah. And you can see the pound. There's a lot more weakness in the pound so far. Euro's back at these lows, and we're seeing dollar yen rising. So a lot of weakness in the yen, certainly there. Okay, coming back over to some of the, not this one. Yeah, right. Looking at gold. So gold, I might just remove this for the time being. Now, it's come back to a very strong level of support, okay? And what we've seen so far is a nice candlestick formation occurring here, right? So this support level here, you can see it's been previously tested 1, 2, 3 times. So 3 tests. Each of these tests, it made a new high. So you can see, so that being the first high, makes a new high, retest the support. Makes a new high, retest of the support. So it's waiting for buyers to really accumulate in this region here around the 1780, should we say 1790 handle, okay? Just below the 1800 mark, shall we say. So a lot of accumulation taking place, and that led to sort of this bull run. But this bull run needs to be attributed to the Russian invasion of Ukraine. So that's sort of the panic and fear with the war that's taking place in Ukraine, right? That's why we saw this bid in the price of gold, right? Since then, it's receded back down to sort of the key 1800 support. But each time it reaches the 1800 mark, you can quite clearly see it's not closed at the 1800 mark, right? So it's had this first few tests, the 13th and the 16th of May, and it's just done that again. Okay, so just recently, so it's done on the 1st of July, which is last week Friday. it's put in another test to the low. Okay, so we put in another test to the low. So yeah, the question is, are we going to see another bull move taking place back above? But this 1800 level, between 1780 through to 1800 level, is a very strong support zone for the price of gold. If it really does break through this and confirms that with a strong close and maybe a couple of day closes, then we could see this certainly more downside risk, and we could see gold, really trend lower back to sort of potentially the 1750, 1760 handle quite easily. But I've seen that there's clearly a very strong support, especially with the pin type of bars type of candle formations that we've seen at these lows here. Yeah. Going on to the oil markets, right? So going on to the oil market, let me just have a look through. Right, yeah. So moving on to the oil markets. Right, don't need that. Yeah. Okay, so now what do we see in the oil market at this moment, right? So what are some of the sort of fundamentals? Now, this is the biggest picture here, right, that we've got to suggest, right, which is even with the current deteriorating macroeconomic picture, meaning that these recession fears are growing because of central bank action, right, and we're seeing a drop in growth, and potentially employment levels are going to be disrupted very soon. That's where we're seeing, okay, oil begins to recede, right, because of that uncertainty on the cards, right? But there's not much of a correction occurring if you think about it, right? It actually sort of comes back to sort of nice sort of trend line that we have in play here. If I just extend that line, yeah. At the same time, you can quite clearly see that it comes back to this sort of key level trend line. I'll remove this point there. I don't need to have put in that most recent high there. Okay, so it's quite. It pulls back enough to show that there's a little bit of fear because of the potential recession on the cards, right? But again, it's not a huge correction. It is not a huge correction like we see in the price of gold, right? Price of gold really did correct, whereas we're not seeing the same situation in the price of oil. Also, let me highlight, data being released with the US ISM manufacturing index came in below expectations for the month of June. Also, we saw new orders fell into contraction territory as well, which is not a great sign for production over what to expect going forward now, right? In the second half of 2022. But there is this other fundamental that you need to be aware of as well, right? Let me just also highlight constructive oil fundamentals continue to counter the weakening macro environment that we're in at the moment, which means that what we're seeing is that there is an inability of OPEC countries to significantly ramp up their production levels, their output, right? So even though they've given us indication that they want to raise their output levels to these amounts of barrels being produced per day, but them actually stating that and doing it is two different things, right? So they are stating that they want to raise production levels, but they're not able to achieve those production levels, right? And that's what we're seeing. The oil market is still being buoyant at these higher price levels, not been a larger correction because of the fear of recession and growth and in the background either, right? So that is what is propping up the oil markets at this moment. Of course, there is some uncertainty that's taking place in Libya at this current moment, which is also, hitting oil and holding those prices at these levels. But it just seems that all producers, with the exception, of course, the UAE, are showing that they're failing to hit those, those modest supply increases that they've stated, recently that they're looking to achieve, right? And that's why we could see then that they come in under the numbers that they've defined for the month of July and for the month of August. And that might keep the oil prices at these elevated levels. But just be mindful of what's taking place in Libya is also contribution to this. But let's see, right? So this is the fight that we're about to see now in the oil market, right? On one side, you have, our production levels being met to sort of what their estimates are, or are they underweight? Are they undershooting those levels? Which could keep the oil price at these elevated levels. On the other side is the macroeconomic economic environment that we're in at this moment, is that going to be a contributing factor? Is that going to be the overriding factor that brings the oil market back to sort of, a more balanced level, somewhere between 95 through to the 100 mark, right? Sort of in that range there. So that's sort of the key point when it comes to the oil market at this moment. Yeah, so that's sort of the key points as to mention there. So we looked at some of the FX markets, we looked at gold, we looked at oil, we looked at some of the equity indices. For the week ahead, as I mentioned, just be mindful of the economic calendar that we've just gone through. This week, there might be some earning reports to keep an eye on, some microeconomics that you need to sort of keep an eye on. But again, most of it begins next week. So earnings season begins next week. Okay, so you've got a bit of a lag there in regards to some of the earning reports to come in line with this. Now, what you're going to gather from this earning reports, I'll probably sort of give you more indication on that next week, Monday's session. But I'll be looking at, not just the earning report in regards to what their earlier forecasts were, because if they miss, that's okay. The miss is not the biggest issue. It's their forward guidance, what they're expecting going forward for the upcoming quarter, for the next 2 quarters, right? Are they looking to cut job offers or reduce their workforce, right? So, these are some of the key elements that we want to hear from this earning reports. That gives a good indication of how they are adjusting in the current climate and what they forecast that the macroeconomic picture looks like as well. But again, I'm going to share more insight on that in next week's session. For the week ahead, the focus is macroeconomics, as I mentioned. We've got the RBA, we've got the Fed meeting minutes, we've got a lot of ISM sort of numbers and sort of PMI data that are being released as well. So just be mindful from those sort of key elements there. And of course, the most anticipated, the non-farm payrolls. So keep an eye out for non-farm payrolls at the end of this week. That's it from me. Hopefully you've enjoyed another weekly market analysis. I'll be back next week. Any questions in the meantime, please feel free to reach out to me directly if you're part of our online community. We have a community on Telegram. We also have our private Slack members community. If not, do send an email over through to hr@alphachain.co.uk. Other than that, enjoy the upcoming trading week. Wish you the best of luck. Take care. Bye-bye.